Today I want to talk about how the stock price is determined. Um, Normally when I put a video, I put some analysis or I create some tutorials and I explain different trading strategies. I talk about the market price. So for example, if I create a video and start analyzing Square, for example, we talk about numbers, but for example, here you can see the Square price is 266.72. Many of you are asking how this price is this precisely determined. So who's gonna say that, okay, the price is today 266.72? And when I say that price is based on supply and demand, so there are people buying and people selling, so we have a demand, we have a supply, and those gonna balance each other. You're saying what? But how? How if I want to buy something, that's gonna affect the price? And if it's gonna affect the price, who is going to say, okay, the price is, for example, 265, not or 266.72? So how this final number goes on the screens, like here for on the brokers and on your tablet, or if you're using any device. So how you see just this exact number. So for those of you who are actually curious about the exact mechanics, the open price is calculated by the stock exchanges like the New York Stock Exchange, for example, or NASDAQ. NASDAQ is National Association of Securities Dealers Automated Quotations. It's easier to just say NASDAQ anyway. So on New York Stock Exchange, this exchange is an auction market that uses specialists or designated market makers. NASDAQ is a dealer market with many market makers in competition with one another. So there are two different types of markets. So some are auction and some are dealer markets. So let's talk about dealers versus auction market. A dealer market, on dealer markets, market participants do not buy and sell to one another directly. Transactions go through a dealer, which in the case of the NASDAQ is a market maker. So more than 260 market making firms provide liquidity for NASDAQ listed stocks. This competition helps ensure buyers and sellers are getting the best price. And you know how much the liquidity is important. If there is not enough liquidity, your orders won't be executed anyway. On the other hand, auction market, before the market's official opening time, market participants can enter buy and sell orders starting normally at 3 hours prior to the official opening. And if you look at the, for example, here trading view, you can see some pre-market numbers. These orders are matched with the highest bidding price paired with the lowest asking price. So they want to find the best buyer and the best seller. At the New York Stock Exchange, the job of maintaining markets falls to designated market makers, or DMMs, formerly known as specialists. The DMM is the human point of contact for the listed company on the New York Stock Exchange trading floor. DMMs provide stability by taking the other side of the trade when imbalances occur. Buying when investors are selling, and vice versa. They run the opening and closing auctions using human input and algorithm to help promote price discovery when the volume is typically at its highest. According to the New York Stock Exchange, DMMs provide a big amount of liquidity, approximately 20%. So you can see on an auction market how important is the role of designated market makers. Automated pricing based on supply and demand, bid and ask. So as I said, and as I explained at the start, bid and ask or supply and demand are important, and that's how it works. We explained different type of markets up there. So when you place an order to buy a share at a certain price, that is called your bid. And when you place an order to sell your shares at a certain price, that's called your ask. So sorry if it's too obvious, but I thought better to just put some basics as well so everyone can understand. Every morning, stock exchanges set the opening price by taking pre-opening orders and offers. So the stock price is the highest amount someone is willing to pay for the stock, or the lowest amount that it can be bought for. The calculation of price is completely automated, software-driven, and anonymous at the specific exchange, and the price is calculated by electronically matching bids and offers for a particular share recorded in an electronic limit order book. So that's how it records. Okay, the electronic limit order book contains all the bids asked for particular share, and the system matches the best bids and asks to execute an order. The price at which a transaction is executed is called the last traded price, LTP, and that's what you see on TV screens, on laptop screens, or whatever you're using on your mobile screens. It's usually the price that results in most stocks being sold. So I hope you can understand the procedure now a bit more clearly when we say supply and demand, and you're saying, okay, how that price will be determined. That's exactly how. So they matching the best prices, and on quote-driven markets, the quotes goes based on the best price. Then if two quotes are equal, then goes based on the time priority. I think that's enough for this topic, and just for those of you that want to know how the stock price determines. Otherwise, don't worry, just go and learn the technical analysis or trading strategies, etc., and start trading on your own. I hope you learned something new. This is my weblog anyway, how to trade forex. Apadana Forex, and also you will learn many other things like stock trading and about cryptocurrencies and many things. Anyway, I hope you learned something. Have a nice day. See you later.